All right, welcome to this highly focused explainer. Consider this your ultimate A-star masterclass on errors not affecting the trial balance. I'm your subject specialist, and I'm thrilled to be joined today by our senior examiner to really help you bridge that gap between basic data entry and high-level financial intelligence.
Exactly. Thanks for having me. Today, we're deploying what we call the advanced technical methodology. This means we're not just going to sit here and memorize rules. We're going to fundamentally understand the complex cause and effect chains that actually drive modern accounting.
So, looking at our roadmap for today, we're skipping the basic fluff. We'll start by locking down the core architectural foundation, move straight into technical execution, where those precious method marks live, and then tackle AO3 evaluation. Finally, we'll wrap up with some direct examiner warnings, a look at AI accounting, and our signature pause and think challenge. Let's dive right into that first part, the core architectural foundation, specifically looking at the 2028 to 2030 syllabus standard. Now, you might be wondering what's changed. Well, Cambridge now demands absolute 100% accuracy using modern international terminology. That means you need to be confidently using terms like irrecoverable debts and owner's equity.
Right. And from a grading perspective, this precision is literally make or break. If we're grading your paper and see you still writing bad debts, it's an immediate red flag. It tells the grading team you aren't operating at the current global standard expected of top-tier candidates. So update your vocabulary.
Absolutely crucial point. Now, underpinning all of this is the beautifully simple accounting equation. Assets equal liabilities plus equity. It's the backbone of the duality of every single transaction.
And here's the thing. Whether you're correcting an error of omission, commission, or principal, that duality has to be perfectly maintained throughout the entire fiscal period. Grasping this duality intuitively, that's exactly what separates a student who's just guessing from an A-star candidate who truly knows the mechanics.
You also absolutely have to be comfortable applying concepts like accrued, prepaid, realization, and consistency to those really complex Paper 2 scenarios.
Because remember, the records you're fixing in these exams aren't just theoretical classroom exercises. Real-world stakeholders, we're talking banks, owners, tax authorities, they rely entirely on the absolute integrity and transparency of these exact records to make massive annual decisions.
And honestly, let me issue a direct examiner warning right here. We constantly see students overstating profits by ignoring potential losses. Make no mistake, this is a blatant violation of the prudence principle. Examiners flag this specific issue year after year. Overstating profits by ignoring a potential loss violates both prudence and the historical cost principle. It's a massive conceptual trap. Rule of thumb, always anticipate losses and literally never anticipate profits. That's a golden rule right there. Okay, let's transition into our second core area, technical execution and method marks, or how to secure every single point available to you. The procedural flow here is strictly logical. You just can't skip a step. Step 1, extract the raw data from the correct source document, like an invoice or a credit note. Step 2, accurately record that into the books of prime entry. And then step 3, which is absolutely critical for your AO3 practical skills. You map that data onto the gold standard of double entry, which is the T-account structure. Now, visually speaking, you have to nail the distinction between bringing down a balance, your balance BD, and carrying one down, your balance CD. Remember, the balance carried down closes out the current period, while the balance brought down opens up the new one. Mixing these two up is a totally unforced error, and we absolutely have to eliminate it. Getting this backward completely shatters your transition to the trial balance and cascades into a nightmare of further errors. You also really need to watch out for those common mathematical pitfalls. Things like forgetting state symbols in manufacturing accounts, or, this is a big one, confusing the percentage calculations between trade and cash discounts. Actually, here's a super quick memory hack for when exam pressure hits. Just remember your alphabet. T comes before C, meaning trade discount is always calculated and deducted before you even look at the cash discount. I love that hack. And speaking of exam strategy, I cannot emphasize this next point enough. In the IGCSE examination, method marks are awarded even if your final balance is completely incorrect, provided your logical flow is visible. Seriously, show all of your workings, especially for those complex multi-step problems like depreciation or inventory valuation. Please do not do the math in your head. Put it on the paper so I can actually give you those points. Free points if you just show your work. Okay, let's move into our third segment, AO3, Ratios and Evaluation. This is our analytical deep dive.
Let's say you're sitting in the exam and you're given a scenario where a business's current ratio plummets dramatically, falling from 2.5 to 1 all the way down to 1.1 to 1.
Now, simply calculating that drop, that doesn't get you an A star. Identifying exactly what that ratio means for the underlying liquidity of the business, that is what defines top-tier AO3 analysis.
Right. The crucial part is investigating the why. Why did the ratio fall? Did massive capital expenditures suddenly drain their cash reserves? Or are we maybe sitting on a mountain of overpurchased, unsold inventory? Or perhaps their trade payables are just being settled way too slowly. Exactly. Debating this exact cause and effect chain is exactly what examiners are desperately looking for in those extended response questions. You have to trace the real-world impact. And this same analytical thinking applies heavily when you're doing inter-firm comparisons. Comparing a business that uses straight-line depreciation to a competitor using the reducing balance method, it's literally comparing apples to oranges. Their results might be massively skewed simply because they use entirely different accounting policies. You must point this out as a key limitation in your evaluation. And remember, to hit those top band marks for Assessment Objective 3, you have to step back and evaluate the non-financial factors too. You need to weigh qualitative elements, things like staff morale, physical store location, or overall market reputation. Look, these will never show up in a ledger, but they deeply, deeply impact the long-term sustainability and the return on capital employed at the business. So true. All right, moving on to our fourth segment, examiner warnings and the new AI accounting mandate. So, keeping up with the 2028-2030 research directives, we really need to understand modern industry applications, particularly cloud accounting systems like Xero. Now, these systems automate the entry process, but they still completely rely on fundamental manual principles.
Spot on. Think about it. If an error of principle occurs, say, classifying a brand new vehicle purchase as an everyday expense, the AI doesn't know any better. It will flawlessly generate a completely 100% incorrect financial statement. Your human analytical skills, they remain the ultimate safeguard in the modern industry.
And keeping that human element in mind, here is my direct, no-nonsense checklist for you. Recent examiner reports show students are bleeding marks for totally avoidable reasons, like incredibly poor handwriting in ledger accounts. Let me be blunt. If I can't read your balance C over D, I cannot legally give you the mark. Also, failing to strictly distinguish between revenue items and capital items remains a massive pitfall. So manage your time, write clearly, and classify correctly. Clear, practical advice. Which brings us to our final segment today, the Pause and Think Challenge. Okay, here is your ultimate A-star challenge. We want you to pause this explainer in a moment and completely trace this cause-effect chain on a piece of paper. If you ignore a financial loss, how exactly does that violate the prudence concept? And crucially, how does that artificially inflated profit cascade down and misinform the tax authorities who are relying on your financial transparency? Really chew on that. Think about the real-world legal and financial consequences of that error. If you can confidently work through that logic, you are officially A-star ready. Thanks so much for joining us on this Masterclass Explainer. Keep practicing, and we'll see you next time.